Our next learning objective is to prepare a make or buy analysis. A decision to carry out one of the activities in a value chain internally rather than to buy externally from a supplier is called a make or buy decision. In other words, should we manufacture or make a part or component of a part or product internally, or should we outsource? That's the decision we're going to take a look at. Let's consider an example. For the Essex company, they manufacture a part called Part 4A that's used in one of its products. And the unit product cost of the part is given as follows. We've got a direct material cost, direct labor, we incur variable overhead, depreciation on special equipment, supervisor salaries, and general factory overhead. And our total unit cost is $30. If we've been approached by an outside supplier to provide 20,000 of the parts at a cost of $25 per part, should we buy the part or should we continue to make the part? Recall the part was costing us $30 to make internally. We need to consider some of our additional information. The special equipment we're using to manufacture Part 4A has no resale value or alternative use. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. In other words, it's a common allocated cost. And the $30 unit product cost is based on 20,000 parts each year. So again, should Essex make the part or should it buy Part 4A? The cost of buying the part externally is $500,000. That's 20,000 units times the purchase price of $25 per unit. If we make the part, we'll incur $180,000 in direct materials. That's 20,000 units times $9 per unit. We'll incur $100,000 in direct labor cost, $20,000 in variable overhead. Our depreciation on our equipment, since it has no resale value and is a sunk cost, is not relevant to our decision. The supervisor's salary will be $40,000, and that's 20,000 units times $2 per unit. And our general factory overhead is a common allocated fixed cost, and it will be incurred whether we make the part or buy the part, so it's not relevant to our decision. So when we compare the $340,000 cost of making the part to the $500,000 cost of outsourcing the part, Essex should continue to make the part. Let's consider another example. Troy Engines Limited manufactures a variety of engines for use in heavy equipment. The company has always produced all of the necessary parts for its engines, including its carburetors. An outside supplier has offered to sell one type of carburetor to Troy Engines for a cost of $35 per unit. To evaluate this offer, Troy has gathered the following information relating to its own cost of producing carburetors internally. 2/3 of the traceable fixed manufacturing overhead is depreciation on special equipment with no alternative use, and 1/3 is salaries. Assuming that the company has no alternative use for the facilities that are now being used to produce the carburetors, should the outside supplier's offer be accepted? Let's begin by looking at our differential costs if we make versus if we buy. Again, the outside purchase price is $35 per unit. If we make the product, we will certainly incur direct material costs. Direct material, direct labor, and variable overhead are by definition avoidable costs. If we do not produce the units, we will not incur these costs. So in our differential cost analysis, we will want to include our $14 per unit direct materials, our $10 per unit direct labor, and our $3 per unit variable manufacturing overhead cost. Of our fixed manufacturing overhead, we're told that 2/3 is depreciation on special equipment with no alternative use. Therefore, only 1/3 of it, or $2, is for salaries, which are an avoidable cost that we can eliminate if we purchase from an outside supplier. The fixed manufacturing overhead, we're told, is an allocated common fixed cost. We will incur it whether we produce the product or not, so it's not relevant for our decision. Our total differential cost of making the product then is $29 per unit. And when we compare this with a $35 per unit purchase price, we should continue to make the product. What if instead, if the carburetors were purchased externally, Troy could use the free capacity to launch a new product, and the segment margin on the new product would be $150,000 per year? Does this change Troy's decision? Should Troy Engines Limited accept the offer to buy carburetors for $35 per unit? The first thing we need to do is consider the voidable cost if the part is purchased. And the avoidable cost if we purchase from external supplier would be $435,000. That's the $29 per unit we calculated above times the 15,000 units. The segment margin on the new product that we were going to launch was going to be $150,000. We need to compare these two costs with the cost of purchasing from an outside supplier. The cost of purchasing from an outside supplier was $525,000. That's $35 per unit times 15,000 units. So Troy will save $60,000 if it purchases the product from an outside supplier, because it will be able to earn the segment margin of $150,000. It will be able to save $435,000 in avoidable costs, and it will only cost $525,000 to purchase from the outside supplier.